I'm Andrea Johnson. I'm the Grant Financial Education Coordinator for the Office of Consumer Credit Commissioner for the state of Texas. And I have 15 years of experience working in the news. I have a lot of research background, and I've actually received an Emmy for Best Daytime Newscast while working here in Austin. I am married. I have 2 kids, a cat, a dog, and now fish. I'd also like to point out that this webinar is for informational purposes only and does not constitute legal advice. So a little backstory in the Texas Office of Consumer Credit Commissioner real quick before we get started. We license and regulate certain non-depository institutions. We protect and safeguard consumers against abusive and deceptive lending practices, and we educate consumers and creditors about their rights and responsibilities. Here are the few of the industries that we license and register. For instance, we license payday loan lenders and pawn shops, and we register manufactured housing creditors. And I always like to mention pawn shops again because they're everywhere. You see them on every road. If you're driving on I-35, you see them everywhere. If you've ever been inside a pawn shop, if you've ever known anyone who pawned anything, then you've had some kind of indirect contact with our office. We also provide consumer assistance. We are here to protect you from misrepresentation, fraud, and deceptive practices. We address complaints, provide information about credit transactions. We help you understand terms of contracts and legal rights, and we mediate disputes. If you have a complaint or a concern about any of the industries that we license and register, then you should call our consumer assistance helpline. Recently, someone was asking about a car dealership that they were having some issues with, and we were able to direct them to the consumer assistance helpline for that information. And we do have some questions coming in, and we'll try to get to those. It says, under COVID-19, is credit history and FICO score free? And what does that one say? Also, can a person with ITIN access their credit history? So when it comes to your credit history and your credit score, you can get that free once a year, at least, from the 3 credit reporting bureaus. And we're going to tell you exactly how to get that. It has nothing to do with your credit history, and your access to your credit report and your credit score does not influence whether or not you can see it. That is readily available to you, and I will give you the information on how to do that. Someone also wants to know about info on credit needed to purchase a house. That one I can answer offline. It's not really going to be we're going to talk about general credit terms today, budgeting, some building wealth. Personally, I've bought and purchased 2 homes, so I kind of have an idea about that one, and there's other information I can provide you with on that. So also with the Office of Consumer Credit Commissioner, we provide financial education through Financial Education Coordinator, myself, informational seminars and webinars like this one. We used to do these in person, so it was a lot of fun, actually getting out and seeing all of you face to face, and you could raise your hand and you could just chime in as we go. And so, technology things have changed things, and it's a little bit harder to have that kind of interaction. But hopefully, with your questions in the box, I can try to get to those as we go along today. We also provide financial education materials, such as the handouts I have provided today. I have a budgeting worksheet. I have credit facts brochures that we provide through our website, both in English and Spanish. And I also have provided the slides from today's presentation. So if you need those handouts, if you can't download them, then go ahead and email me and I can get those to you. And then we also do partnerships with other education-oriented organizations. And I like to mention this because I'm the Texas Financial Education Endowment Coordinator and grant coordinator. And so what we do is we partner with different organizations. Every 2 years, we give out funding for those organizations to provide free or at low to no cost programs on financial education for adults, K through 12, and financial coaching. So again, I want to point out that this webinar is for informational purposes only and does not constitute legal advice. When we're talking about financial fitness, I want to thank you to think about how it affects you. Financial stress, for instance, can play a big role in your overall health. It can affect your physical health. It can lead to delayed health care. It can lead to unhealthy coping behaviors, and it can put a strain on relationships. For instance, at least 2 studies by TD Ameritrade found that 41% of Gen Xers and 29% of boomers ended their marriage due to disagreements over money. And so that's a big factor when it comes to your relationship. There are several ways to cope with financial stress. And you can, first you need to understand your cycle of debt. You could possibly create extra sources of income. I know, we feel very strapped and bogged down today. And you should work out a budget. That always helps, which I've included the budget worksheet. And practice stress relieving techniques like focusing on one financial decision at a time, track your spending, identify your financial stressors, avoid temptation, and ask for support. And also attending webinars about financial information and things of that matter will probably also help you. So let's take a quick poll. What aspects of your life do you think are affected by your financial stress? So is it physical, mental, emotional, relationships? What exactly do you think plays a role in your life the most? Is it because you can't get the strength that you need and the support you need when it comes to your finances? Let's see how everyone did. It looks like about 60% of you have answered, so let's close it and let's share it. It always helps to see things like this because you know that you're not alone. There are several of you that logged on today for this webinar. So it's a handful of you who want to know more about credit and budgeting and all of these things. And there's probably some of you that have dealt with financial scams, for instance. And you'll see that 13% of you say physically it affects you. Maybe you're not making those doctor's appointments because you're between paychecks and you're going to have a copay, or you need to see a specialist and that payment is going to be even higher. Mentally, it could be really draining because you are paying your bills and then you turn around and you are broke, and so you're just drained. Emotionally, the same thing. Relationships, maybe you have a spouse who, yes, the PowerPoint is available as a handout in case anyone, I just had that question, and it is available as a handout. And if you can't download it during the presentation, I will get that to you. So let's move along today. Why does having good credit matter to you? Well, for instance, it can get you a new car, a new house, or cell phone service. Do you have a budget to achieve your financial goals? Maybe you want to pay off student loans. Maybe you want to stop living paycheck to paycheck. That's how your health comes into play. Maybe you want to go on vacation. I would love a vacation. What is building wealth and what does it mean to you? Well, maybe it just means paying your mortgage on time or saving money for unexpected expenses. We have elderly pets in my home, and we've had to address their health problems with aging. And so having something set aside has been really helpful with that. And then saving for retirement should always be somewhere in your mind, because you don't really probably want to work forever. So why is it important to have good credit, and why do you need it? Well, credit gives you the financial power to qualify to borrow money or services over time. It means you can be trusted to borrow money now because you will pay it back later. It helps you get a job, rent an apartment, buy a house, spread out payments, get phone service, credit cards, qualify for insurance. What do lenders use? How do lenders determine credit worthiness? Sorry about that. Creditors are typically looking at the 3 C's. This is going to be your character, capacity, and your capital. So your character is how you've handled past debt obligations. Your capacity is how much debt you can borrow comfortably. And your current is your capital is current available assets that you have, such as real estate, savings, capital, that comes into play, also plays a factor when you're guaranteeing loans, like when you get a car loan. That car loan is your guarantee to pay the loan back, because they will take back the car if you don't. So good credit versus bad credit. Good credit means that you have been reliable in paying your bills on time, that companies are more willing to extend credit to you, and they could offer you lower pricing. Now, bad credit could mean that you're unreliable in paying bills on time. You maybe have a high debt to credit ratio, which we're going to talk about that a little bit. Your bills may be paid late and your debts are abandoned. And when they say bills paid late and debts are abandoned, now if you have missed paying your electric bill one month and you paid a late fee, that's not going to show up on your credit. It's not going to go into collections. Now, when you have abandoned a bill or a debt, for instance, let's say you had an electric bill that you couldn't pay and you've moved apartments or you moved houses and you just let it go, that will show up in collections, and that's definitely a factor on your credit score, and it will be in your credit report. Or maybe you filed for bankruptcy. Bankruptcy is a big one. It happens pretty frequently. You hear about corporations filing for bankruptcy. You hear about individuals filing for bankruptcy. So it's not uncommon for someone to have to file for bankruptcy. So what goes into your credit score? It depends on how long your credit history is. The longer, the better. That always helps. It depends on your debt to credit limit ratio. So if you have a credit card that you have maxed out, you need to pay it down in order to increase your credit score, because you're starting to pay a lot more towards debt than what you have coming. Like you're using so much of your income to put towards debt that that's not going to play well in your favor. How many inquiries do you have? The less, the better. So if you're running out and, oh, this credit card is offering us, oh, that credit card is offering that, and you're just automatically, signing up for these credit cards because you want them, or you need the discount, or you want the whatever it's offering, you are dinging your credit every single time you do that. Filling out the application, that is. Do you pay your bills on time? That's another one. Are there any charged off accounts, judgments, or bankruptcies? And credit scores typically range from 350 to 850, and 650 is you're okay. You're somewhere in the middle. You're doing well. But the higher you can get, 750 and above, you've got excellent credit. You should have confidence, consumer confidence, ready to go out, and you can probably get any credit card you want, but you should still say no. The higher the score you have, the easier it will be for you to qualify for the best credit terms. So for instance, if you're going out and you're purchasing a new car and you know what your credit score is, the better the score, the better rate you will possibly get. So there are 3 credit reporting bureaus, and they do not make credit lending decisions. They maintain and compile credit information established by you into a credit report and creditors. Your role in this is to establish credit and check your report frequently for inaccuracies. If something is incorrect, you can dispute it with the creditor and the credit bureau. One of the easiest things you can do is go to annualcreditreport.com for your free credit report. This will come from Experian, TransUnion, and Equifax. And you can do this once a year for free. So there's really no excuse not to check your credit report. And I will address the question regarding the ITIN instead of a social in a second. I haven't forgot about your question. So what is in a credit report? Well, there's personal identification information, account information, public record information, and inquiries. And personal identification not only includes your name and where you live now, it includes your information, any names that you've had previously, any addresses that you've had previously. It's going to include your employers and their employers' your previous employer's addresses. And this is information you need to be verifying so that you know that someone else isn't running around using your credit to obtain different things. There's going to be account information to include whether or not the accounts are in good standing, whether or not your payment history is good. It's going to show all of this information. It's going to show public record information. That includes judgments, bankruptcies, tax liens. What is not in a credit report? Your race, your religion, your medical history, your political preference, or a criminal record. So people, when someone runs your credit and they're trying to make a decision of whether or not to lend to you, they can't make that decision looking at your credit report based on those things. They're just looking at what your credit is and if you are good at paying your bills on time. You know, because if I'm going to lend you money, I want to know that you can pay me back. So there are types of credit inquiries. There are hard and soft inquiries. When a lender reviews your credit report to make a decision, that is a hard inquiry, such as mortgage, auto, or credit cards. It's considered hard because these are tied to an actual credit application, and these will affect your credit score. Now, when you check your credit report, when you check to see what things are going on, or when a lender checks for pre-approval, these are soft inquiries and they do not affect your credit score. I always like to point out when we're talking about hard versus soft is that one is linked to an application and one is linked to pre-approval. So if you're getting tons of offers in the mail right now saying, you know, you've been pre-approved for $10,000 from X bank, that pre-approval letter, fine. You can receive tons of pre-approval letters. It's once you take that pre-approval, fill out the application that's attached to it, and send it back, that now you've had an inquiry against your credit. So you might look at it and go, why am I getting all these credit card offers? Well, that's why. It's because they're going to send a credit card offer to pretty much anyone, but it's that application that's going to hit your credit, and it's going to be, it will affect it negatively. So don't apply for everything that you receive. Should you place a fraud or freeze alert on your credit report? Well, a freeze generally stops all access to your credit report, and it is available to anyone. It's temporary until you remove it. And that's the difference. A fraud alert, a business must verify your identity before issuing the credit, and it remains in effect for 90 days. Now, for either one of these, you have to contact one of the 3 major credit reporting agencies by phone or online in order to place a fraud or freeze alert on your credit. I met someone recently who said that they had been receiving, she and her husband had been receiving tons of credit cards in the mail, and there were items that they hadn't applied for, and these credit cards kept showing up, and her husband was like, what is this? Did you apply for this? And she was like, no. And it found out they were having some issues, and when they logged on, they put a freeze on their credit. They still have a freeze on their credit. So anytime she thinks about making a credit decision, she would have to go in, she will have to go in and take the freeze off. And what I like about this is that it gives you a stopgap between, do I really need 20% off in order to buy something that I may or may not need? It may just be a want. So you kind of run into that roadblock that might help you decrease your excess spending. And so I think that's a good way to kind of help curb any excess spending you might have, is by putting a freeze on your credit, and then that way you have to really think about what you're doing. So one thing to remember when you are repairing your credit is that it takes time. Delinquencies remain on your credit report for 7 years. They cannot be fixed overnight. Public record items, 7 years. Bankruptcies, depending on how you file, 7 to 10 years. If you are considering a credit repair organization, remember to evaluate the pros and cons of that organization. I told someone recently they were thinking about, a friend of mine, they were thinking about hiring a credit repair organization, and I told them to check with the Consumer CFPB, the Consumer Financial Protection Bureau. And so on their website, they have a different list of, you can just type in, credit repair organization, and it'll come up with different articles and things of that nature to kind of help guide you to what might fit your financial situation. So that's always best. So one question I want to ask today, just so we're kind of keeping this on our minds, is how often do you check your credit report? Are you checking it at least once a year? Are you checking it more than twice a year? Are you checking it twice a year? Or have you never checked your credit report? And maybe that's not anything to your fault. Then maybe you just haven't thought about it. So let's see. A little over half of you have already voted. And let's see how everyone stands real quick. Let's close the poll. Everyone's doing pretty good. It looks like 31% of you say you check it at least once a year, 6% say twice a year, 31% say more than twice a year, and for the 31% that say never, we need to get you on the track to doing that, because it would be really good for you to be checking it, and there might be some roadblocks when it comes to checking your credit score, your credit report, and we'll work on that. But at least you can start now by going to annualcreditreport.com and check it. I, for one, had a webinar, I think it was 2 weeks or last week, I can't remember when it was. And right before I said, I went to Experian to look up a question about something else that someone had asked me. And it said, you want to check your credit report. And so just right there on Experian's website, I checked my credit report maybe 10 minutes before my webinar. And it was just really quick and painless. They ask a few questions. Someone during the webinar checked theirs and they said, is it unusual for them to ask for my social? But the thing is, you're going to a credible website. Make sure you're double checking it's the exact one, annualcreditreport.com, not .org, .net, there's so many other things. Make sure to verify that that's where you are. And if it's asking for that information, it's because it just needs to make sure it's giving you the information for you and not someone who's 1-digit social security number different. So another thing that we're going to talk about today is creating a budget. And I know we went over credit pretty quickly, but today's goal is to kind of do credit, budget, and a little bit about building wealth. So when you're creating a budget, everyone is different, but here are some general guidelines using percentages. And there are several techniques. There's the 80-20 technique. There is the 50-30-20 technique, the zero-based budgeting technique. And we're just going to highlight some of those today. So you just kind of get an idea maybe I should check that out. Maybe I should try that one. So you'll see in here that 25 to 30% is housing. Transportation, 10 to 15%, utilities, 5 to 10, insurance, food, entertainment, miscellaneous, personal spending, savings, and giving. Now, on this, you don't necessarily see certain things like a student loan, but you're going to have to reduce some spending in some of these non-essential categories in order to cover things that are essential in order to pay down your debt. So budget ratio techniques. The 50-30-20 technique splits your take-home pay into 3 categories. 50% goes towards your needs, 30% goes towards your wants, and 20% goes to savings and debt repayment. The 80-20 budget is a simplified version of this because 20% goes into savings and debt, and then everything else is the 80%. So the 20% here is also anything that increases your net worth. That is going to include your savings account, paying off debt, and investments. So it's not just, a savings account and credit cards. Someone is trying to have a meeting at the same time I am. So the other one we can talk about is zero-based budgeting. Now, I kind of fall probably between 80-20 and 0% in zero-based budgeting. I'm probably more a zero-based budgeting person because you're going to balance your income and your expenses down to every dollar. And it's the same idea as the envelope method, where you actually take envelopes and put money in the envelopes that you need to divide it up among your expenses. And so it's just income minus expenses all the way down to zero. And I'm kind of this way because I need to know where every dollar is going. So what are the budget categories that I just mentioned earlier? Well, housing is going to also include your rent, your mortgage, your property taxes, homeowners or renters insurance. Some of you may have a mortgage where, I have mine is my equity, and it every time I make my mortgage payment every month, a little chunk of that goes down for property taxes. So I don't even have to pay my property taxes at the end of the year. It's just sitting there waiting for me, and it automatically goes to the county, and I don't even have to worry about it. I love that part of my mortgage because I don't want to come up with thousands of dollars at the end of the year to pay property taxes. Transportation, your car maintenance, gasoline, public transportation expenses, parking, utilities. We're going to include electricity, water, natural gas, trash service, and your cell phone. That is a utility. You can't live without it nowadays. Insurance is your health insurance, your life insurance, and your auto insurance. For most of us, your health insurance, hopefully if you're employed, it's coming out of your employer. Your employer is covering that for you. So that's an expense you don't really have to worry about it because it's coming right off the top of your paycheck. But for others, that is an added expense every month that you're having to pay for. More budget categories include food, but we're not just talking about groceries, we're talking about eating out. We have a problem in my house sometimes. It's feast or famine when it comes to eating out. During the week, I just, no, I don't want to eat out. Let's just get home, get the kids settled, make dinner, and we're at the house. Now on the weekend and mom is really tired, I don't want to cook. And so that can really put some strain on the budget for the month when we're really lazy about that one. Entertainment is going to include things like Netflix and, maybe you have a Prime account, Disney Plus, all these streaming services nowadays, those are all going to fall into that. Miscellaneous, your extra funds for all the things that will come up during the month, because things will come up. You can count on it. How much they cost, you can't count on. Will they happen? Yes. Personal spending, we're going to include haircuts, clothing, maybe a Saturday Target run, which those have really gone down in my house thanks to the pandemic. Savings, pay yourself first. Even if you're just putting $5 to $20 in the account every month or every time you get paid, that's something you could be doing to just kind of help you create a little something that you can set aside. And giving. So if you have a charitable cause that you care about, make sure you're putting that in the budget. Don't just when someone calls from an organization, you're like, oh, that's really sweet, and you just write them a check right then and there. Make sure that's something that you have budgeted. Here is what a budget might look like for you. Again, these are using the percentages. And if you have something like a student loan, like I mentioned earlier, you'll see that one's in there. You're going to have to cut back. You'll see entertainment is not 5 to 10%. It's personal spending, miscellaneous spending. Those were all at 5 to 10% earlier, and now they've been kind of ticked down because you just need to make adjustments for the things that are needs. So you need to pay off your student loan instead of wants. You don't necessarily need a new pair of winter boots if last year's boots still fit and look great. How do you know how much to put in each category? Well, you need to review your receipts, credit card or bank statements to see what you're spending in these categories on a regular basis. And you might think, oh, this sounds so easy. But the thing is, I wouldn't necessarily leave today's webinar if you've never budgeted, if you've never looked at your bank statements, and just say, I'm going to start a budget. take about a month, look and track your spending, see where everything is lining up, and you might be surprised. You might be spending more than you think in different categories. I know before everyone has a debit card instead of a checkbook, I was vigilant about my checkbook registry. I wrote every little thing down. I could see where every little dollar was going every time I spent something because I had to write a check. And so there's something about writing a check and swiping a debit card where you can almost have a disconnect. It's so easy just to swipe that piece of plastic and, answer a few buttons, a few questions on that little keypad than it is to have to sit there, take out your checkbook, write a check down. You're having this mental separation between your money. And same thing goes with online shopping. Make sure you're tracking what you're spending every month on your needs, your wants, those receipts. Every time you place an Amazon order, a Walmart online order, Target, make sure you're tracking that spending and gather it and to see how much you're actually spending in those different categories. So if your after-tax pay isn't enough to cover all of your expenses, then you need to adjust your categories. Like I just mentioned when it comes to student loans. When your income increases, don't increase your spending. You want to stick to the same budget. So that's another way to kind of help build up your savings account. If you have an account that's not attached to your everyday spending account, it's really good to go ahead and if you get an increase, if you get a raise or a promotion, yes, if you get a substantial promotion and you need that money to help curtail some of your spending and help your budget, then of course, some of it is allowed to be used. But maybe just increase how much you're putting in savings. If you weren't putting anything in savings before, then start with something minimum like $20 every time you get paid and just have that come directly out of your paycheck before it goes into your bank account. Try to pay off debt and save the extra money. So everything is about whittling stuff down and then, piling it away in a little nest egg so you can use it when you need it. One of the things we want to talk about today, when we're talking about budgeting, when we're talking about credit, is paying off debt. That's a big part of it. That's a big part of increasing your credit score. That's a big part of having more money in your budget for the fun things that you want to do. So there's a few things you can do. One is the debt snowball, which means you're going to pay the minimum payment on everything, and anything extra goes to the smallest balance. And what this means is regardless of how high your interest rates are, like let's say you have one that's 23% interest and one that's 0% interest, you're going to make the minimum payment on the 0% interest, even if it's the highest balance. And then the one, regardless of its interest rate, if it has the smallest balance, $200, that's the one you're going to chip away at. And I kind of lean toward this because I want to see that whole thing paid off. And so that's going to give you that faster way of getting that smaller card paid off and taking it out of your debt that you need to pay off. And so you're going to have less credit cards, less debt at that point. And then you just turn around and start chipping away at the next one. There's also the debt avalanche. So what this means is that you're going to pay the minimum payment on everything, and anything extra goes to the highest interest rate. Reason why this works is because that highest interest rate is just increasing your balance owed on that debt substantially every month. Like that just, it's just adding up every month. And so by chunking away as much of the extra income that you have to go towards it, that's going to start really bringing that down. And then the lower the balance, the lower the interest charge that's going to be on there. So think about also consolidating credit cards. Now, when you think about this, you want to consider balance transfers, but watch out for fees. You'll see a lot of things that say, open this new credit card, balance transfer, 0% interest for 12 months. Okay, so That sounds great, but if you make those balance transfers and the amount that you're transferring cannot be paid off in 12 months, then that 0% interest is only helping you temporarily. It needs to be a balance that you can still pay off, because you're going to be hit with interest at the end of those 12 months. And that is going to probably put you in the same boat you were in. Now, if you haven't already, one way to stop to help your debt repayment is to stop using credit cards or other debt to finance living expenses. So if you're getting to the ends of the month, or you're getting to right before your next payday, and you go, oh, I really need XYZ, and you whip out the credit card, take a moment, take a breath, really think about if that's what you need, because if you are using that credit card to take care of the debt take care of an expense every month, then it's just a cyclical thing that's going to keep happening. So if you can, allocate extra money to debt repayment. Debt snowball, debt avalanche, they talk about spending extra towards your different balances. So if you have a part-time job, if you live in a multi-generational family where everyone is working, see if anyone can contribute. And maybe you have a talent that you could do on the side to bring in a little extra money to help pay off debt. And that money just goes specifically to an account to help pay off debt. My Venmo account, for instance, is hooked to a savings account. So anytime I do something crafty and I sell it, that money goes to my savings account. And so it helps build that up, because it's extra side money that I didn't have before. It's not money that I have budgeted into my income. And so it's something that I'm not relying on. So that's another thing you could do. This one might sound funny to all of you, but ask for lower interest rates. You don't know unless you ask. For instance, I had a credit card back in the day that had a really high interest rate, and I was able to get it down because I had really good credit. I had a history of paying that bill on time. I had a history of paying other bills on time. And so it doesn't hurt to ask. All someone can say is yes or no, and you won't know unless you ask. And that's really one of the good things to remember is you just need to think about your credit. I don't know. It's something that can be built. It's something that can be changed. It's something that will give you confidence. Getting out of debt will give you confidence. It'll help with your credit. It'll get you out there, and you make the financial decisions instead of someone making the financial decision for you. So our next and last poll will be, do you have any goals for building wealth? And this is going to go right into our next session about building wealth. And what that means, and maybe you haven't even thought about it. Maybe your goal is simple. Maybe your goal is putting a patio on the back of your house. Maybe your goal is buying a boat. Maybe your goal is saving for retirement. Maybe your goal is reorganizing your closet. Little pandemic problems that I keep coming up with. And so maybe that's what building wealth means to you. Getting a new cell phone, getting a new car, getting out there and just being able to make financial decisions without someone stomping on them. So let's see how everyone is doing today. 79% of you, that's good, say yes, you do have financial goals. 7% say no, and 14% say they haven't really thought about it. And to me, it's really not unusual for people to say they haven't thought about it, because, what is building wealth and what does it mean to you? There you go. That's my question. What is building wealth and what does it mean to you? Does it mean having the house on the hill? Does it mean having a ton of cash in your pocket? Does it mean having the fanciest car and the newest phone? I had the same cell phone for probably 5 years, so that's definitely not my building wealth. Well, for some, it means paying your mortgage on time. saving for unexpected expenses, or saving for retirement. And when you think about retirement, you want to think of it as a stool, you know, and it's got these 3 legs, and you need all 3 of these little legs for your retirement to help you stand financially when you finally decide to retire. And hopefully that is a goal for most of us. I know I would like to retire. Some days I would like to retire sooner rather than later. But you need to think about your retirement because it is part of building wealth and financial wellness for your future. When it comes to building wealth, the first step to do is determine your net worth. And you might think, oh, I don't have any net worth. I don't own anything. I don't have, you know, I'm too young. I'm too this, I'm too that. But what that means is just taking any of your assets that you have, your individual or your business owns, that your individual or business that can be exchanged for commercial value, correct? Liabilities, you're going to subtract your liabilities from your assets. So any money an individual organization owes, so the same as your debt. So any debt that you have, those are your liabilities. And the difference between those is your net worth. So let's look at what a balance sheet would look like for this. And this is kind of something you can also tie into your budget. So your assets, that's going to include anything you have in savings, your stocks, your 401k. So we're talking about retirement again, the value of your home and the value of your car. So even just going to Kelley Blue Book and seeing how much your car is worth will tell you if it's an asset. And then you want to subtract your liabilities. So maybe your mortgage, a home equity loan, your car loan balance, any credit card balances you might have, your student loans if you have those, and any miscellaneous liabilities. And so you're going to subtract your liabilities from your assets, and that equals your net worth. So every one of us probably has some net worth. And it's just interesting to kind of look at that and see what it is. And that can kind of help you get your mind, it'll kind of help give you more of a positive look on your financial standing. Even if your net worth is very small, it can kind of help give you a little bit of confidence, you know, and that's what is really important about working on your credit. That's what's important about managing your finances is consumer confidence. That's a big one. I would like to just share a little thing that, you know, we went and bought a new car. Well, we traded in our car for a bigger one. We needed a bigger SUV because our kids are not getting smaller. And I already knew what my credit score looked like. I knew what my credit report looked like. I knew that I had paid off a house because we needed a bigger house because, again, the kids aren't getting smaller. And I knew that I had paid off several vehicles over history, over time. And I knew what it looked like. And so I went into the dealership and I said, you know, when they come back and they say, oh, okay, well, let's send this out and see where you stand. Let's send this out and see how good your credit is. Let's send this out to creditors and see what we can do for you. And I just kind of looked at them and said, okay, first of all, you're not going to run my credit until you give me a price that I want. So we're not going to haggle over, you know, $1,000. This is what I want. This is what my car is worth. And I know what my credit looks like. And I've already spoken to my bank and you're going to give me what I want. And the process was so mine at that point. I had the confidence to look at that person that I'd never met and said, this is what I want. And this is what you're going to give me. And that's it. Period, the end. And that's exactly what I got. I looked over old paperwork. I paid less for the larger SUV that we're in now than the smaller SUV that we had previously purchased and traded in. Because I wasn't looking to be hassled. I was looking to get what I wanted. And I had the consumer confidence because of my credit history, because of my budget, because of all of those things, to go in there and say, this is what I want, and this is what you're going to give me. One other thing is setting goals when it comes to building wealth. Do you have goals? So short-term, intermediate, and long-term financial goals. 3 different categories for goals, not just, long-term retirement, not just buying a house long-term. We're talking short-term goals of less than a year. So a quick emergency savings account, small household repairs, maybe a weekend getaway. Those are things that you can look for right now and plan on, and it might just, make you feel happy when you accomplish those smaller goals. And it might prepare you for intermediate and long-term goals. The intermediate goals are going to take 1 to 4 years, like maybe a down payment on a vehicle, maybe an extended vacation, or major home repairs. Long-term goals, of course, take 4 years or longer, so a down payment on a house. I know someone who is in this process right now, their eye is on the prize, they're making cutbacks, they're doing what they can because they want to buy a house and retire. Or maybe you want to buy a boat. Down here the weather is great, probably 98% of the year. So buying a boat is definitely an idea when you're in the Austin area. Maybe you're looking forward to retirement. So this is a long-term goal, and it should be somewhere in your, if you put it out there, it'll happen kind of thing. But you got to budget and have goals, and this will help you build wealth because everyone has a different idea of what building wealth is. Now, how do you achieve your financial goals? This is something that if you do download the slides, you probably want to look at this over and over again, just to kind of remind yourself that, keep your eye on the prize kind of mentality. So one thing you want to do is you want to write down your goals and make them visible. I have a marker board in my house, and I take notes and write things down. And these are some of the things that we write down. We write down what we want to accomplish, what we want financially that's long term, that requires a little bit more oomph on our part, and be specific and make them achievable. Also, how much will it cost to achieve these financial goals? Not just the monetary cost, but consider your support system and sacrifices that may be necessary. So for instance, if you, like us, would like to put a new patio in the backyard, that is quite a cost. And so we're going to have to sacrifice some of the other things that people in the family want. And it's going to be important that we're all on the same board and on the same, we're looking ahead to the same goal. You want to communicate and rank your goals and share them with your family members. For instance, that new patio back there, that affects the entire family. So we want to communicate with each other and make sure that everyone knows what the ultimate goal is. Establish a timeline, and remember that there could be setbacks. You want to establish a timeline, use this to determine the monetary line item in your budget, so that big budget you saw, and it is a handout today. What part of your budget is going to be affected by your financial goal? For example, if your goal is to save $1,000 for a new car down payment over the next 18 months, you'll need to set aside roughly $56 a month. And that will get you to $1,000. And $56 a month, a family of 4 eating out maybe one to 2 times, that's $56, depending on how large your children are. Our 2-year-old eats way more than our nearly 4-year-old does. So it can get a little expensive when we go out. And always remember to be flexible and keep your eye on the prize. You may have to reset or compromise when it comes to your financial goals. And that's because there's going to be unexpected expenses. For instance, I mentioned earlier, we have elderly pets in our house, and it seems like every single one of them has had some kind of health issue in the last month and a half. And so that has taken away from our savings. But we had the savings to where we didn't have to put those charges on a credit card, those bills on a credit card. And it gave us the financial freedom to not have to go in debt to take care of our pets. But it did cut into our savings account quite a bit. So just be flexible. Like I said, you may have to reset and start over again. And that's not a problem. That's not a big deal. So just a wrap up of today, financial stress can lead to poor physical, emotional health and put a strain on relationships. And several of you answered that question earlier that, financial stress really does, it affected almost everyone in today's webinar. You are not alone. You want to work on improving your credit by paying down debt, paying bills on time, and keeping an eye out for inaccuracies. You want to check your credit report at least once a year for free. And you want to build a budget and determine your percentages, and then deduct those percentages from your after-tax pay, because if you can't cover everything, when we're talking about the budget, you need to cut back on your discretionary expenses. And some people I've heard say, oh, I've already cut back. What else can I do? And so, it might be another part-time job. It might be selling off some of the stuff sitting around your house right now that if you're working from home, you're seeing every day. Set realistic short-term and long-term goals in order to build wealth, and also those intermediate goals. So once you hit those short-term goals, look for those intermediate goals, look for those long-term goals in order to build wealth. And then all of these things will help consumer confidence as you go along. So if you have any questions that you want to ask offline, you can email me financial-education@occc.texas.gov. If you weren't able to download the handouts, please go ahead and do that. And I can also email those to you if you want them. And so we are going to I hold these webinars every Thursday at 10 o'clock. I'm not going to have one next week because of the Thanksgiving holiday, but starting just 2 days after my birthday, I will be back online to help everyone. I really like these webinars. I really like talking to people and answering your questions. I really appreciate you inviting me into your little space.